Investing can sometimes feel like solving a puzzle, especially when you are trying to understand new financial products. You might be looking for ways to diversify your portfolio, and commodity exchange-traded funds often come up as an option. While commodity ETFs can be a great tool for accessing commodity markets, the simple answer is yes. They can carry hidden investment risks that go beyond the usual ups and downs of the market. It is important to understand these specific nuances to make informed decisions. The main reason for these less obvious risks lies in how many commodity exchange-traded funds are structured. Unlike an exchange-traded fund that holds company stocks, many commodity exchange-traded funds do not hold the physical commodity itself. Instead, they often invest in futures contracts, which are agreements to buy or sell a commodity at a future date and price. When these contracts approach their expiration, the exchange-traded fund must sell the expiring contract and buy a new one for a later month. This process is called rolling over contracts, and it introduces a unique risk known as roll yield. If the price of future contracts for later months is higher than the current month, a situation called contango, the exchange-traded fund buys the new contracts at a higher price than it sold the expiring ones. This difference can lead to a drag on returns, even if the spot price of the commodity is stable or rising. Conversely, if later month contracts are cheaper, a situation known as backwardation, the roll can actually add to returns. However, contango is often a more common scenario in many commodity markets. Another factor is tracking error, where the exchange-traded fund's performance may not perfectly match the underlying commodity index it aims to follow due to management fees, trading costs, and the complexities of managing futures positions. So, what can you do with this information? First, always read the prospectus of any commodity exchange-traded fund you are considering. This document will explain whether it invests in physical commodities, futures contracts, or a combination. Look for details on its rebalancing strategy and how it handles contract rollovers. You can also research the historical performance of the exchange-traded fund compared to the actual commodity spot price to identify any significant tracking error. Additionally, understanding the current futures curve for a commodity can give you insight into potential roll yield effects. A steep contango curve might signal that the exchange-traded fund could face headwinds. This concept of roll yield is a critical insider detail that separates savvy commodity investors from those who only look at spot prices. It is not just about the supply and demand for the commodity today. It is also about the cost of holding and rolling those futures contracts month after month. For example, if a commodity exchange-traded fund is consistently rolling contracts in a contango market, that cost can quietly erode a significant portion of your potential gains over time, even if the commodity's spot price has performed well. By understanding these deeper mechanics, especially the impact of roll yield and how commodity exchange-traded funds manage futures contracts, you gain a clearer picture of their true performance drivers. This knowledge empowers you to look beyond the surface, evaluate exchange-traded funds more thoroughly, and ultimately make investment decisions that better align with your financial goals and risk tolerance, helping you protect your money in dynamic commodity markets.